Hi, everyone. Jackson Vaughan here. I'm from Konvoy Ventures. We're a venture fund. We focus specifically on the gaming space. We're based in Denver, Colorado. I'm actually in Cambridge, Massachusetts, but entirely U.S. based. But we invest globally. So we have investments throughout the Americas, Europe, Africa, um, Southeast Asia, and we're interested everywhere. We do seed and Series A investments, typically investing anywhere from 500K to $3 million checks. We like to lead, but we're fairly flexible and just really want to be supporting founders in this space. A little caveat on us: we typically don't do content investments. We usually focus on platforms and technologies in the gaming space. We're a team of 7 or so right now, and we're just thrilled to be here. But today I'm going to be talking a little bit about exiting for founders, and how to go about timing that and thinking through that. So if we can put up the presentation, what I'm going to go through is sort of the what does it mean to exit? Why should founders exit? How they should think about it, and when. What's the right time to think about exiting? So jump into this first slide. What exactly is exiting? I think at the end of the day, all founders really kind of know what this is, but really just to break it out, there's really, I'd say, 3 main ways that you can quote unquote exit your startup. The first one I call a merger. You're merging with another company, and so I don't personally view this really as an exit from your startup, and that's just because you're probably going to be merging with some other startup, and you're doing that so you can accelerate your business. You're doing that for various reasons, but you're not, as a founder, taking money off the table. You're not getting that quote unquote exit, which is usually what people think of. They've built a great business, and they're retiring from that business and taking the money off the table. That's typically not what you see when a merger is happening. But I think we usually see M&A, right? Merger and acquisition. So the other side, the acquisition side, is the second bullet point here, and I think that's much more typical of what you'd consider an exit. And what you'd see here is really you're selling your company, and it is being acquired by some third party. And this may be, likely another player in the space who's much larger. It could be a huge corporate. It could be a number of things, right? We've seen SPACs also over the past few years, and that's another form of an acquisition as well. But I think what you're going to see here is you're going to see, full liquidity up front, right? Which is really quite incredible for the founding team, as well as the early employees that are at the startup, and as well as the investors in the company. So the various shareholders there. This is a pretty great outcome, generally speaking. What you don't necessarily always think about, I think, is what happens after the acquisition. Usually there are lockups where you need to be actually working with the corporation that's acquired you, and continuing to run your startup. So, usually it's not I sell my startup and then I'm done, right? And I just walk away. Typically you have at least a couple years where you're contractually obliged to stay and support the business as it is integrated into the larger corporation, and continue to grow it, right? But you're no longer sort of operating as a standalone entity. You are part of a larger corporation, and therefore you definitely lose some autonomy. And so I think typically you see founders coming from larger organizations, and they've left that and they decided to start their own thing, and they really enjoy their autonomy. And then they find that when they go back into it, it's a little bit nerve-wracking and a little bit difficult. They have to deal with the bureaucracy and sort of the difficult decision-making structure that comes with that, right? The last one I'll just put out there, obviously, is the IPO. I think that this is sort of that huge outcome that many founders dream of. But there are a few caveats there, right? Partial liquidity, right? It's not all upfront, as you would typically see in an acquisition. No, in acquisitions, you will get maybe stock or shares of the acquiring company, but in an IPO, it's very much partial on that front, and it's really geared at incentivizing the founding team, the leadership, and the management for future performance, right? And you're really bringing this to the public and saying, hey, we think we're we think we're going to do considerably better moving forward. And so you are continuing to fundraise in that sense, right? I think people don't necessarily think of an IPO as a fundraise, but you are raising funds to continue to execute on the company. So from that perspective, there's more operational freedom, right? You're not operating underneath another corporation in that sense, but you do have public equity scrutiny on that front, right? Which is a lot more to deal with than call it existing investors and VCs that you might have dealt with up until that point. And there's a number of regulatory processes and public reporting that's mandated that you must do. So it's a lot more to deal with. But the companies that get to IPO, I think those are ones we typically think of as being really quite successful, and it's obviously a wonderful outcome for founding teams, management, and the teams that build all these startups. So I think that's a good framework to think about. Okay, what does it mean to exit, right? And these are kind of a few of them. Okay, now what we know what it is, but when should we and why should we exit? Right? How do we kind of think through that, and what's the framework there? So I think one thing is you got to take into account the market environment, right? Are there favorable valuations in the market today? Are there potential buyers who could be interested? Are they active? Are they going out and buying companies? This is particularly or specifically on the acquisition side. And I think in the gaming space, right, especially on the studio front, you're definitely seeing this, right? There's a lot of M&A activity going on, and so if you're a founder and you're thinking about being acquired right now, hey, you can check this box. The market environment is actually quite favorable from that perspective. But I think you also need to think about more specifically around your business, right? And what are the competitive dynamics, and how does your business operate in the market? Is there some strategic value of you being acquired by another group, right? Or by raising immense amounts of funds through an IPO? Could your business perform better through having some of that strategic backing by a corporation, or having that much more additional capital in the bank to go after the opportunity? Not always, right? That's not always the case. Maybe there's nothing, but maybe if you were acquired by a certain organization that had infrastructure or some sort of distribution channel, whatever it might be, there is strategic value in your acquirer, and you should definitely be thinking about that. Now, the next one I'll talk about is a little bit touchy, leadership. Look, not every founder is positioned to take the business from, call it, 0 to 10 million in ARR, or as I've gotten the slide here, 0 to 500 million, right? That's a completely different thing. And then 500 million to 10 billion. These are completely different types of operators. And I think that founders often think about this from the perspective of, hey, this is the company I started, and I want to go through it to the end. But I think we all need to sort of take a step back and think critically about what our strengths and weaknesses are, and where we perform the best. Many founders, do come to realize that they're much better at operating at the earlier stages. Some founders, of course, and there's a number of great examples out there, can really go the whole spectrum there. But I would not take this personally, I think, in terms of, hey, maybe I'm the person that takes it from 0 to 100 million, but then past that, it's a little bit more difficult for me as an individual. And maybe I should focus on product, or maybe I should become the CFO, or the head of business development, or whatever it might be, depending on what my strengths are as a founder, and bring in someone who has expertise in scaling up a team from, call it 100 people to 1,000, right? That's a very different type of person than someone who has taken the team from 0 to 20, call it. So I think, founders and management teams really need to think critically about this, and to really understand, am I the right person to scale this? And if not, one way to help you get there is through some sort of exit, right? Where if you go through an IPO, you can bring on another CEO, or various parts of your management team to help you with that scale. Or if you're being acquired, right, the organization that is acquiring you might have those individuals in house, right, and they could be really quite beneficial for your business. And then somewhat related is founder fatigue. Look, starting a company is no small task, and I think there's founders don't necessarily always realize how much they're signing up for, and so you might be all excited for the first few years, but 7-8 years in, it might be really quite tough. And thinking through your personal dynamics, your home and family life, what you want for the future, right, needs to be taken into consideration. And that's not just for the founding team; that's also for the entire management team and the underlying team that's building the company. And so, if founders and management teams are quite fatigued on that front, it might be worth considering, hey, maybe we need to tap out here because we're done. And those are always difficult conversations, but really important to have, because success and sort of motivation, I'd say, does tend to come from the top. And so, if you're not showing up 100% or 120% every day, it's hard to expect your team to do that as well. But I think, when it comes to what's the ultimate, question around when and why to consider exiting, I think that you really need to ask yourself the question is, what is the best thing for my business and my shareholders? And I think what is somewhat tricky there is that sometimes those things can be at odds to an extent. So, the longevity of your business, could be sustained over decades, right? But it might be only a 2 million ARR business, and there may be no real acquisition potential there. But let's say you've got investors who own, 40% of your business. They might be pushing for a potential exit in the future, and that's not to say, in 2 years or 3 years or whatnot, but, in 15 years in, it might be something that your shareholders really do want. And there might be differences of opinion at the founding team as well, among the founding team. And so you really do need to ask yourself those questions: is, am I looking for a payday here, or am I looking for longevity of my business in the long run, right? And answering that question up front, I think, will help guide you in terms of the decision making, the decisions you make sort of on a strategic level throughout the life cycle of your business. My last slide, I'm just going to close on some thoughts here, and then I'll open it up to some questions. But look, timing is really difficult for anything, right? I think people do try to time markets, and it's really tough. My viewpoint is I just purely avoid it if I can. I think there are, of course, entire companies that are bet on timing, right? Timing of when market dynamics are going to change, and they've done incredibly well, but it is a little bit of a gamble for sure. Because oftentimes we see companies that are, doing incredible things, but they're just a few years or a few decades even too early. But timing your exit is also something that's incredibly difficult. So it's hard to plan for and say, hey, in 2 years we're going to be able to exit this business. I think you have to continuously strive for building a sustainable business that can weather market downturns, and is profitable, right? So I think, profitability should become before any of these thoughts on how do we and why and when should we exit. The second point here is exiting is very much a luxury. Most startups, fail and they die before they get to the point of even being able to consider this fully. And so I think if you're a founder thinking about how I should go about exiting, I would just encourage you that, hey, you've gotten a lot farther than many other founders are able to get to. Just because it's hard, it's very difficult building a business of this, building a business at all. This is balancing of interest is something I mentioned in the last slide around what do your shareholders want, what's good for your business, what do you as a founder want? Think about this upfront. I can't encourage that enough. If you're taking on venture capital money, right, they're going to want you to exit in the future. And if that's not in your plans, be upfront about that, right? Because you're going to save yourself not just hard conversations, but really difficult dynamic in terms of who owns your company. And that's that this just goes to the last point about know what your goals are and plan them accordingly. If you want to build a lifestyle business, that's absolutely wonderful, right? And I think that you should strive to do that, but plan accordingly, right? Don't take venture capital money. Don't sell the opportunity of IPOing and saying this is where we're headed, when that's not necessarily your plan. And think through if that really does want to be your plan, because it's true, it really is not for everyone, and it shouldn't be, because it's very, very few companies get to that stage, while you can still build an incredibly long-lasting business without any of the above. So these are just some thoughts around why you should exit, what exiting really means, and why you should I strongly encourage everyone to think through what they want that to look like for their business from day one, really. But I'll open it up to questions now. What's the average timeline of binding the founder to company after acquisition to complete the process, and duration of non-competition roles? This really varies. I have not seen any real data on this, because this is typically all private. But I think what we typically see is at least a couple years, at least 2 years of you need to be here, and your shares are going to be locked up, right? So you're not actually going to get a payday for call it 2 years, and they might have 2 years, and then you're vesting over. It might be the vesting period might be a 2-year cliff, and then it'll be a 1-year period or a 2-year period of quarterly unlocking of your shares there. On the non-compete side, I think typically I've seen that be a little bit longer than the lockup even, right? So for your shares, so you might be bound to 2 years, and then you've got another year of the unwinding, and then but it's actually 5 years for a non-compete, right? Because typically, if you're getting acquired, you're probably pretty lethal talent, right, for what you're building. And the acquiring company definitely doesn't want you to be going out and building another business or getting hired by a competitor in the space. So you'll see the non-compete last typically longer. When do VCs want to exit? Yeah, that's a good question. It will vary for sure, but just backing into it from the perspective of what are VCs measured on? They're measured on the multiple returned on their fund, and the rate at which they return capital. So there is certainly a interest from VCs to return capital faster, right? Because the faster they can get money back from an exit, the faster they can return capital to their limited partners, their investors, right? But what is typically modeled out really is a 7 to 10 year sort of investment cycle of we put money in, we support the business, and we expect companies to have some sort of exit in that 7 to 10 year cycle. Now, it really does depend though on the situation of the company. If VCs are starting to notice that, hey, this company is doing really quite well, then we do want to support it until it hits that peak inflection point. Because if you exit too early, you leave money on the table in a sense, right? But I will say, if venture capitalists start to notice that a company is somewhat struggling and they're not necessarily able to get market share, they're not able to grow the business considerably, then they might encourage, hey, an earlier exit, because it is just better to take money off the table than to leave it there. The other thing I'll throw in there is that there's also timing consideration. From the perspective of what the market dynamics are. If the market is quite frothy and there's a lot of acquisitions and M&A is going on, and valuations are quite high, then yeah, your VC might encourage you to say, hey, consider it, right? But I think as a founder, you should ask these questions in terms of what the expectations of the venture capitalist will be, and you should vet them on this, right? Because you're going to want a VC that might have preferences, but is not going to force you necessarily to do any of these things. Because if you truly believe that, hey, you've just hit a rough patch with your business, but the opportunity is still here, you're going to want a VC that's going to support you and back you in terms of pushing through. Is there any protection for the founder after the exit? Have you seen cases that the founder was fired after the exit? Oh, absolutely. Yeah. And that's something that you definitely need to take into consideration. When you sell your company, it's no longer yours. And that's a really important thing to take. And so, when you do consider the acquisition offer, think deeply through that, right? Are you willing to part ways with this and give up your ownership of the company that you've poured your heart and soul into, probably? So yes, no, the answer is yes. Like, it's no longer your company, and there's most likely you're most likely putting yourself at risk of being fired. Now, read through the documents of what the acquisition offer is. You can have provisions in there that keep you on board for a certain amount of time, or give you a certain amount of autonomy. Read about the past acquisitions of the acquiring company. They might have really great, wonderful relationships with the companies that they've brought on before, and leave them to act somewhat autonomously, right? So it's always contextual on that front, and I would do your homework. I think that's all the questions, yep. Well, thank you everyone for your time. Really appreciate it. I think that it's really interesting to think about, and I think it's an important thing for founders and management teams to think through. But thank you for listening. Really appreciate it. Everyone have a good day.